As UBS sweeps in to rescue Credit Suisse, our next guest warns that this is not a, quote, stable equilibrium in the long run, and the banking sector may be more fragile than before. Columbia Business School Associate Professor Kairong Xiao joins us now. Thank you for being here, Kairong. And, you know, does seem to be calming nerves to some extent today. But then talk to us about the bigger, more long-term picture and why it may not be a picture for stable equilibrium.
Yeah, for sure. Thank you so much, Julie. So I think it's kind of useful to step back to kind of recount what just happened, right? So we had U.S. regional banks, which account only less than 1% of the total assets of the U.S. banking system. And its failure actually triggered the collapse and eventual bailout of a global systematically important bank, Credit Suisse, which has survived 160 years, right? And, the fact of this kind of the fragility in the system is mind-boggling. So it shows the lack of confidence of investors in the current banking system, although we know that there are tons of new regulations have been installed post-2008 financial crisis, but it seems that it didn't really manage to address those fragility in the system. Okay. So we know that today, after this news has been released, in the short term, it helps to calm the markets and investors understand that, the regulators and the policymakers are willing to do whatever it takes to save the banking system. But, this is just kick the can down the road, right? Kick the can down the road. So also in this kind of a really rushed bailout, it exposed some of the confusion that stemmed from the post-crisis regulatory reform. So, for example, some of the bond investors was shocked to know that even if equity holders get bailed out, their bond value essentially get completely wiped out. This really took some investors as a surprise, and then they kind of realize and they go back to read all the kind of the covenants of the bond and realize that this is already written in the fine prints of the bonds. So I think there's a lot of shock in the so-called cocoa bond market, where essentially it's kind of a new thing installed by the regulators after the financial crisis. So not everyone investors are kind of aware of these small intricacies, and then the ECB have to come out to kind of clarify that this is just a Swiss thing, right. And all the kind of European banks don't have that issue. So I think it is good that this bailout came very fast and helped to calm the market, but it do kind of expose some of the kind of fragility in the system.
Sure. So we had a guest earlier that said, I would hesitate to call this a crisis, but for investors who have absolutely seen the wild swings that have taken place and ensued in everything from banks that are directly exposed to some of the collapses that have taken place, or those that are really just kind of on the fray of this or on the fringe of this all, is there calm that you believe will enter into the markets?
Yeah, definitely. So I think the fact that the regulator really act very swiftly, instead of in 2008, people debate whether we should bail out the banks, how should we do it? I think the regulator act very swiftly. That kind of clear out some of the uncertainty that the market participants may have. Which is really good. However, as I mentioned, it does expose some of these ambiguities in the regulation. So I wouldn't say that now we can go back and sleep soundly. So I don't know how many surprises going to come down the road. So I think the regulator should take this as a good opportunity to review the system that we installed after the 2008 financial crisis.
Right.
You can out some of the issues.
But you can act swiftly without the swift action being correct, because what's been exposed is more of a systemic type of issue that we need to mitigate. Has that been mitigated?
Yeah, so definitely not. So that's a good point in the sense that, the regulators doing, for example, the kind of the wipeout of this AT1 bond, which is the additional tier 1 capital bonds. And, a lot of investors had the impression that if it's a bond, so the priority should be before the equity holders. So if the government bail out the equity holders, these bonds should be saved. but they were surprised to know that actually these bonds get completely wiped out. So I think that's kind of the thing that, even if regulators and policymakers act swiftly, sometimes the market just don't understand, or it was confused about something that they didn't have time to digest. So for example, in this bailout deal, the shareholders of the two banks don't even have the right to vote, right? So essentially, the deal went through so fast, and we can see that the UBS stock price actually dropped before and then recovered afterwards. So it just shows that investors do need some time to kind of really understand what's going on. And I'm not saying that they understand what's going on, because Credit Suisse is such a gigantic bank. It's have like 2 times of the balance sheet of Lehman Brothers. There are so much complicated things going on. So I think investors still need some time to understand, what's there in the balance sheet, whether there's another bomb in the balance sheet that's going to explode later on.
And yet the bombs, though, are unique to Credit Suisse, right? In other words, the bank was unique and its problems were unique in many respects. Do you think that there is a broader systemic risk that is still yet to be discovered? Or do you think indeed we have had containment? And if there is more risk, where does it come from? What is it?
Yeah, so I do agree that Credit Suisse is having problem for a long time, right? So you have a governance problem. It runs from scandals. In scandal, you have a problem in their risk management. However, I don't think that's the problem is kind of confined in Credit Suisse, and the banking sector is saved just because of this bailout. The reason I'm saying is that this bailout really exposed some of the fragility, in the sense that now we have this Cocoa Bank bond sector essentially shut down for the European market, because now investors realize, okay, there's something I don't understand, this new regulation which is installed after the crisis. Now maybe we need to step back and kind of understand all the fine prints. So these things are kind of what I'm talking about. It's not because other banks also have these issues in terms of risk management, but because the fact that there are new regulations sometimes are kind of complicated, and it seems that regulators hope they can stem out events like this, but it didn't. So it really shook investors' confidence. So this problem is kind of drastically different from US. So I think as a US investors, it seems that we don't need to panic right now, because we have a totally different problem, where the main problem is in the kind of mid-sized regional banks, where some of them have too much uninsured deposits, and these uninsured deposits are flooding. So it's a different problem from European banks, where the additional tier 1 bond market is shutting down, which spill over to HSBC, things like that. In the US, I think the problem that the regulator needs to think about is that how should we think about the uninsured deposits above the 250,000 insurance limits, right? So I think that is the key issue that may lead to problem in the US banking system. If, say, that investors lose confidence and they are systematically moving deposits from small or regional mid-sized banks to big banks, and these small, medium-sized banks start to fire sell their assets, I think that will be a problem in a US system, so which is quite different from the European one.
Yeah.
And so far, I don't see that being very likely. But again, if there's further surprises down the road, I think this kind of a spillover, not in terms of direct exposure, but in terms of the investor psychology, may affect U.S. banks.
Most definitely. And I imagine that regulators and members of Congress will be deliberating whether to make some of those changes over the coming months. Thank you so much, Kairong Xiao, Columbia Business School professor. Appreciate your time this morning.
Thank you, Judy.